The European debt crisis showing no signs of easing yet. Bond yields in Spain and Italy soared today, weighing down all the European markets, and the S&P credit raters say they might downgrade Portugal's credit rating. CNBC's Steve Sedgwick has the details from Lisbon, Portugal. Hello, Steve.
Guys, thanks very much indeed. Yes, despite official assurances that there is a line being drawn in the sand after the Irish bailout at the weekend, it seems the European capital markets are still very nervous in the current trading session. We saw yields on government bonds oscillating near recent highs. For instance, here in Portugal, the government yield closed around the 6.93 level for the 10-year paper. That's after being well above the 7% level during the session. For the Italian 10-year paper, that was trading around the 4.66 mark at the close, and the Spanish debt for 10-year notes trading at around 5.5%. Also record levels being shown in the CDS market as well. For the first time, we saw Italian yields on CDS trading around about 200 basis points over the yield of the 10-year German government bond. The foreign exchange markets also saw the euro under pressure, trading around the 130 mark, but that's now down for 7 straight sessions, down around about 6.5%. Here in Portugal, well, the Lisbon government is saying that actually they have an austerity plan in place. They don't need an Irish-style bailout. But the problem is when they're paying 7% for 10-year paper compared with the 5 to 5.8% level that is the coupon on the Irish and indeed the Greek bailout, question marks remain over how long they can continue to pay the market rate for their sovereign debt. All this is weighing on the markets, of course, and will continue to do until we get really a resolution and the markets get more reassurance that the government and indeed the wider ECB and indeed European Commission do have a plan in place. With that, I'll hand it back to you in the studio.
All right, thanks very much, Steve Sedgwick. We appreciate the update. So, Europe's clearly got its hands full with the debt fear sweeping the continent. My question is, though, how do investors here avoid getting burned in all this? Maybe even turn a profit. So joining me now is Lee Munson, Chief Investment Officer, Portfolio Asset Management, and Michael Cugino, Portfolio Manager at the Permanent Portfolio Funds. Mike Cugino, I had this thought today while we were covering this story this morning. Why not just stay the heck out of Europe? So don't own any European stuff. Just stay right here in the old U.S. of A, where things look a lot better.
Or just invest in gold and treasuries, Larry, which have rallied quite a bit the last couple days, in part, I think, of the fear of what's going on in Europe. Yeah, it's a good point. I mean, U.S. companies are attractive in the stock market right now. They're fairly valued. A lot of them have global businesses. The dividend yields are favorable versus bonds of just about any stripe other than high yield and distressed debt. And you can wait for market, multiple expansion when more money comes flooding in with the liquidity on the sidelines. So not a bad idea for a long-term investor.
I mean, gee whiz, when this thing gets off the front pages, our stock market could look great, Lee Munson. And I want to say to you, I want to ask you about this. There's no evidence that this business in Europe, the debt woes, there's no evidence it's going to bring down the world banking system. This is not a meltdown situation. It's not going to bring down the world economy. So as I say, my friend, if it's off the front pages, then maybe it's time to buy the U.S. stocks. Come in on this little corrective dip. What do you think?
Well, I think you're right. I'd probably disagree with Michael on, buying treasuries. Any more up, and I'm going to be looking to sell them short. But what we have right now is a classic case of German propaganda. Remember, only last week, the Germans posted the highest business confidence numbers since the reunification of Germany, when they still use the Deutschmark. This is simply propaganda to put in people's minds that could the euro really fail? Any reasonable economist or reasonable Wall Streeter knows that it's logistically impossible right now to really dissolve the euro. So what it's giving Germany a chance, which has great economy right now, but if they can weaken this euro and convince everybody with this fear in the market, it's going to weaken the euro and it's going to give them an advantage to sell more exports. I want to buy the S&P. I'm looking at 1140 as a level, but Larry, we have to have this dollar not continue to skyrocket upward.
No, I agree.
The dollar has to stop.
In the first segment of the program, I do agree. I want a steady dollar. See, if the dollar keeps rising, it imparts a deflationary monetary influence. And this is what we saw last spring during the Greece crisis when the dollar went up almost 20%. Now, so far against the euro, the dollar's up about 9.5%. I say enough is enough regarding the dollar. That is a potential issue. That's why I want tax rates to stay down. But Mike Cugino, when you're not buying gold and treasuries, what are you buying? You have a fantastic long-term record, and it doesn't sound to me like you're panicked over Europe. So in our market, what do you advise investors to do to make some dough despite Europe?
No, I mentioned stocks, Larry, and I think they're attractive for U.S. investors long term. I would say that there is a risk of a slowdown in Europe potentially, and that would eventually impact U.S. profits. But I don't think there's a significant risk of a huge hit there. I would probably agree with you. And so I think that's attractive. Treasuries, I agree, they're relatively, on a historical basis, they're way overpriced. But, I mean, look what happened to yields across the curve in the last couple of days when people got nervous at Europe. They're in a longer-term trading range until our monetary policy gets squared away, and if there's a fear trade there, you can make some shorter-term money trading the yield curve, and so I wouldn't disown them at this point.
What's your
I think you got to be careful.
What's your favorite sector?
I mean, but
hang on, just let me get Mike Cugino. What's your favorite sector?
I continue to believe in the worldwide growth story because I think Asia's not as bad as it's been cracked up to be lately, and I do think the potential is there in the U.S. market. So harder asset stocks, U.S. industrials with a global reach. I do like financial services in the U.S., not the hardcore residential banking, but some of the ancillary businesses or the asset service providers.
Hey.
You can't have a viable economy without a strong financial system.
So Lee Munson,
aggressive but longer term there.
Lee Munson, is Wikileaks going to bury the Bank of America? Dick Beauvais says not.
No, I'm actually with Dick. I was listening in beforehand, and I love what he has to say. It's one of the few banks that we still want to own, that we still own, and when I get ready to rebalance this week, I'm going to be looking to buy more Bank of America. Some of my clients think I'm crazy. I've tried to explain to them the reality of the situation.
Would you buy silver? Silver very much in the news again today, as it has in recent weeks. Do you like the silver? Poor man's gold,
No, I think,
Munson?
I think you just said it. When silver starts popping up, that means that we have the last of the punters in, we have the last of the speculators. I say silver goes lower. Anytime you see silver go up, it means that you're right. It's the poor man's gold. Why do I want to invest with the crowd right at its fever pitch? Okay, we're getting ready to see no inflation. We're getting ready to see this big 10-year run on gold start to end, and silver is going to be your tail. Wow. When you see silver start crashing down, you better start getting rid of your gold. You better start readjusting your thoughts about treasuries. I think if you want to make a quick buck, do nothing. Look for defensives like your Campbell's, your Kellogg, but avoid things like Caterpillar, because a strong dollar, not just Caterpillar, but also McDonald's, is going to make it.
The global
it's not good for cats.
The global plays get hurt if the dollar keeps rising. I agree. I hope the dollar doesn't keep rising.
Forget the global place. China's as bad as it is.
Lee Munson, thank you very much. Michael Cugino, we appreciate the advice. There are ways to make money off this European debt problem. Heck, stay out of Europe.